afternoon or morning or probably night, whatever part of the world you are in right now. So we here at the Center for Constitutional Law and Policy, today we are organizing another very kind of a unique topic, that is an expert talk on the overview of the minimum global tax assessment. So this is one such topic which has got its roots not only in the realms of, let's say, business law, but it is equally relevant for other public laws like constitutional law itself. We'll get a fair view from a very renowned resource person from a very esteemed institution as well. We have got Mr. Gabriel Sullivan with us today, who is a tutor at the Inter-American Center for Tax Administration. So we are really pleased and delighted to have you, sir. I'll just give a brief introduction of yours before handing over the session to you. Sir has got a very enriched academic background. He is an accountant and economist at the Universidad de Buenos Aires International Tax Program, Harvard University. He's a tax expert specialized in transfer pricing, and as I told you, he's also a tutor at Training Directorate of CIAT, that is the Inter-American Center of Tax Administrations. So a very warm welcome to you, sir. We are really delighted to have you on board with us today. The session is yours, sir.
Okay. Good afternoon, good evening, and good morning. As first says, whatever you are, wherever you are. Okay. First of all, I want to thank to Parul University, and first, I'm sorry for this invitation. It's a pleasure to me to get in touch with all you people. Okay, we are going to see a quick overview about this new international tax initiative, the minimum global tax. I don't know if you have heard about that. It's a very important issue that is nowadays is internationally under discussed. We first of all, since this is an OECD initiative proposal, I could like to introduce you a very quick introduction about what OECD is, for those of you who don't know what OECD is. So let's move to the first slide. I don't know if you can write the presentation first.
Yeah, I'm playing your presentation, sir. It is visible.
Yes. Okay. The OECD is a multilateral organization which joined 35 countries so far. Most of them are developed economies, democratic economy. These organizations deals with a lot of public issues, not only tax issues. For example, it deals with education, public health, a lot of issues in order to assist governments in their functions. But from the tax point of view, the OECD committee is the Committee on Fiscal Affairs. But in order to coordinate international issues, the OECD has created a wider institution, which is the Inclusive Framework. So the inclusive framework is composed of 135 countries. Um, this is the environment through which the OECD reach all the world in order to deal with tax
The,
issues.
so there seems, sorry to interrupt, sir. There seems to be a little background noise. Uh, is anyone around, sir?
Uh, Not near here. Okay. What's about now? Is it still that sound?
Okay, okay. Continue, sir.
Let me see. Um, so probably it's, what's about now? Can you hear me right?
It's perfect, sir. It's perfect.
Okay. Okay. We were talking about the OECD, what the OECD is, and how OECD deals with tax issues. Okay, the OECD, in order to reach uh, worldwide, um, created this inclusive framework. This inclusive framework is very important since is the institution used in order to coordinate these international issues as this global minimum tax. Uh, in fact, right now, the global minimum tax is discussing by this inclusive framework. Okay, we could move on to the next slide. Okay, what's the global minimum tax means? This is a way to try to counter tax evasion that takes place by the use of non or low tax jurisdictions. Um, Also, when not only when this kind of tax of jurisdictions are used to evade, but also could be preferential tax regimes that are used in an artificial way in order to pay less tax. This is one additional measure to counter that evasion. For example, when an international multinational group um, set a related company in one of these jurisdictions and they performed and it performs transactions in order to evade. This is a very common aggressive tax planning that we can came across during our work. So this is this is the goal of this minimum global tax. The goal of this minimum global tax is to reduce the incentive to use this kind of tax jurisdictions or preferential tax regimes. So, as you probably already may know, OECD has been dealing with this kind of evasion through 15 actions which are called BEPS, based on and profit shifting. This global minimum tax is an additional measure to BEPS actions. So we are going to see what this minimum global tax consists of. So we could move forward. Okay. Of course, if there is a pillar 2, there is also a pillar 1. Pillar 1 is another OECD initiative in order to analyze how to tax digital transactions in an international environment. But we are not going, of course, dealing with that pillar 1 in this presentation, but pillar 2. Pillar 2 is this initiative, which is the minimum global tax. So first, if you could please move forward to the next slide. Okay, this is I repeat this because I think it's the key issue of this. The minimal global tax tries to counter the use of non or low tax jurisdictions or preferential tax regimes to evade taxes, and how this proposal work. We are going to see a very simple example, in order to get to know how this proposal works. So we can move forward. Here we have a simple example. For example, we take an India pharmaceutical company. In this case, we have an income statement of that company. Well, since we are dealing with international transaction and we are going to incorporate another jurisdiction, this example is in dollars. So you can see a very simple income statement: revenues, expenses, net income, the corporate tax rate 26% in India, and so the corporate tax. This is the initial, the first. This is the first situation. But what's happened next? Suppose that this Indian pharmaceutical company assigned one patent or patent or more or one or more patent to another company which belongs to it, but this another related company is set in a low tax jurisdiction. So we call low tax jurisdiction because it has a tax rate that of only 5%. So this is the next move that this company has made. So what happened with our income statement after this assignment? So let's move to the next slide. And here you have the situation. The Indian pharmaceutical company has increased its expenses. You can see there are expenses too, royalties paid to the related company. So the Indian pharmaceutical company is going to determine a lower net income. And as a consequence of that, it's going to pay a lower tax in India. So this is the first move that this company has done in order to pay less taxes. But as you can see, it's an artificial way to pay low taxes. It's an aggressive tax planning because the only thing that this company has done is to assign the patent to a company that already belonged to it. Since the Indian company is determined a lower tax, a lower income is paying artificially a lower, less tax. So let's move to the next slide. You can see there that we are considering right now not only the Indian corporate, but also the related company. Here you can see that the related company is obtaining the royalties received from its parent or ultimate parent company, we called the Indian corporate as the ultimate parent company because it owned the related company. And so here you have, of course, this related company is going to pay taxes in the low tax jurisdictions, but the tax rate is 5%. So if you consider the group as a whole, you can see that what the group as a whole is paying in concept of tax after the assignment of the patent is lower than the tax that the group had paid before that assignment. Not only that, not all the tax that the group, not only the tax that the group as a whole pay right now is lower than it had paid before, but also some of them is paid not in India, but in the other jurisdiction in which there are not substantial activities, because this is an entity that only owns the patent and probably doesn't do any additional activity. So this is a not fair situation. So this is the kind of situation that the global minimum tax tried to counter. So as you can see, this is an example of what BEPS are. What is a base? What is a base earning and profit shifting? This is an example of that. The group relocate the ownership of the patent in order to shift earning to another jurisdiction in order to pay in an unfair way fewer tax. So how this proposal deals with this situation? We can move to the next slide. Well, Pillar 2, which is this minimal global tax, consists in four rules. Four rules that interact among them in order to ensure that those uh, gains obtained in the other jurisdiction pay a, a, a higher tax. So a minimum tax that is agreed, that is internationally agreed. For example, the proposal so far is suggesting a 15% tax, global minimum tax. So the idea is that these gains that are paying only 5% in the concept of tax is going to pay 15% under this proposal. So wherever the group obtain, wherever in the world the group, wherever in the world the group obtain its gain, are going to pay at least 15% under the concept of corporate tax. So this proposal managed to do that through these 4 rules. But there is one main rule among these, which is the income inclusion rule. The other one of them is a complement rule of the main rule, and there are 2 others that are supplementary rules. But the main rule, which is the one we are going to see very soon, is the income inclusion rule. The other is the complement rule, which is the under-taxed payment rule, and the supplementary rules are the subject to tax rule and switchover rule. So in the next slide, you can see this is a diagram in which you can see how these 4 rules interact in order to achieve our goal, which is that any gain pay at least that minimum 15% tax. As you can see from this diagram, some of these rules require some domestic legislation in order to be applied, because it's a top-up tax. It's a top-up tax. So in any country that has to be set by a domestic law. But also these rules are going to require some adjustment. Some is going to require the update of some tax international treaties. Double taxation tax treaties have to be modified, probably in internationally way, in order to implement this minimal global tax. So as you can see, it's a complex proposal, but it could be possible. The negotiations are very advanced, but you can see that it's going to have impacts not only in the international tax treaties, but also in the domestic legal environment. So we are going to see the income inclusion rule. Of course, we don't have time to see the others. This is, as we have already said, it's a complex methodology. So in fact, we are going to see the income inclusion rule um, uh, as an overview of it. Well, the income inclusion rule consider the group as a whole. So the income inclusion rule is going to work with the consolidated financial statements. Of course, the proposal is not to include all multinational group under this minimum tax, but only the biggest. Um, so far, are including the multinational enterprises, which obtains 750 billion euros in revenues. As we have already said, we have to consider the ultimate parent entity of the group that, in our example, is the Indian pharmaceutical company, and the other entity that may make up the group. In our example, in our very simple example, we are going to consider also the income obtained by the related company set in this low tax jurisdiction. So we can move forward. And here you can see how the methodology works. This question of it that is called jurisdictional blending. And so we are going to consider all the gains obtained by this multinational group. And as you can see here in the chart, the Indian company have this lower tax because it had transferred the patent, and is paying $1,300,000 in India, and in the low tax jurisdictions paid only 5%. So, as the name of the rule implies, the proposal includes the income of that related company and set a top-up tax, which is the difference between this internationally agreed rate, which is 15%, less the 5% tax paid in the low tax jurisdiction. Once we determine this additional or this top-up tax, where this tax is going to be collected. This tax is going to be collected in the place where the ultimate parent company is set. In our example, in India. So the group is going to pay a top-up tax of $270,000 in India as a consequence of this global minimum tax. Of course, this is a quick overview of how this rule works, because it has another complexities. For example, the tax rate is the tax rate of the in the low tax jurisdictions is not the nominal rate. It's an effective tax rate. So it's necessary to make some calculations in order to determine that effective tax rate. So you have to take into account some deductions and other issues in order to determine the effective tax rate paid in the low jurisdictions. So in order to review, we can move forward to the next slide. In order to review this, we have to have clear that the goal of this minimal global tax is to avoid the use of not only low or no tax jurisdictions, but also these preferential tax regimes that many countries have. Even developed countries, um, industrialized countries have these preferential tax regimes for certain activities, and these preferential tax regimes um, are going to be affected also by this minimal global tax. The main important rule in the framework of this multinational global tax is the income inclusion rule, which is the main rule, and it's interesting to it's interesting to point out that this minimal global tax has already been has, a very, has the support of the G20, in which India is part of the G20. So India has also supported this proposal, this initiative. Right now is under consideration in a worldwide um, environment, which is the inclusive framework that we have already talked about. What is important to know what is the inclusive framework. So right now it's under discussion in that framework, but India has already supported this. India and the most important developed economies, as India has supported this, and so right now has put forward under consideration to the rest of the world, and is expected to enter into force in 2023 if the income inclusion framework approve it. Well, I don't know if I was able to explain. I don't know if I was explaining so rapid, so quick. So please go ahead. I am open to any question you may have in this regard.
Uh, so you um, like when we talk about various constitutions across the world and various foreign policies of nations, there is a very popular concept of double taxation avoidance agreement, DTAA, right? So uh, and the model, the broad model which you proposed with respect to the minimum global tax right now, do you see both of them surviving simultaneously? Conceptually they are a little antithesis of each other, they are little opposites of each other. So can both of them go ahead simultaneously, or probably we will have to compromise on one of the two, either the double taxation avoidance agreement or the minimal global tax?
Well, of course, um, it's going to be necessary to once the global this tax is agreed internationally, is going to take um, next steps, and one of those steps is to adapt all the tax conventions, double tax convention, but it could be made as it has already made internationally in only one step. So the OECD probably is going to propose the new statement to be included in this in the double taxation conventions, and all the countries are going to be able to adopt it by joint this international amendment. So um, probably the worst is not to modify the tablet task conventions. Probably the most difficult step is the adjustment, the adoption of this top-up tax in the domestic law, because the modifications of the double conventions treaties is possible to do in only one step, as it has already done. So it's not going to be necessary to renegotiate each double taxation convention. But the issue is that uh, each country, each of these 135 countries, has to adopt this top-up tax. You know, this is probably more difficult because inside each country could be some people some institution people who probably disagree with this top-up tax. In fact, right now in the United States, there are the private sector, many companies that are against of the top-up tax. So this is going to be the difficult part from the law, from the adjustment of the law, in order to apply this global minimum tax. So it's not going to be a problem in the international law scenario, but probably in the domestic law scenario. So as long as the countries don't adopt this top-up tax in their each legislation, it's not going to be possible to apply this minimum global tax.
Right. Thank you, sir. Any questions from students? Yeah, do we have any questions from the students' end?
Do you want first to review some of the slides that you consider and that it's necessary to review if you wish?
Uh, I believe you can, if appropriate, you can just, you know, just a second. If you could just explain this slide in little simpler terms, it would be great, sir.
Yeah, the the conclusion the
Yeah.
conclusion is that um, this minimum global tax uh, is an additional measure to counter the evasion that takes place uh, uh, mm, by using the low or no tax jurisdictions or even the preferential tax regimes. Um, of course, when they are used in the framework of an aggressive tax planning. Um, but this this so it's going so when a jurisdiction is going to set or these jurisdictions are going to have not sense from the tax point of view or these preferential tax regimes are not going to have any sense because because even though they have a lower tax, those gains, those profit that are going to obtain there or under those preferential tax regimes are going to be taxed by a top-up tax in the jurisdictions in which the ultimate parent parent company of the group is, where the headquarters of the multinational group are. So this is the objective of this minimal global tax, and that is the first thing that we have to understand in regards this global minimal global tax. For example, in our example, the Indian the ultimate the Indian ultimate parent company is going to to pay this top up tax in India. Um, the top up tax applied on the revenues obtained by the group in that low tax jurisdictions. That is the main idea of this minimum global tax that we have to have clear. So far the tax rate agreed in the framework of G20 is that this tax rate is going to be 15%, because before, just 3 months ago, there there wasn't any agreement about the percentage, but so far this percentage is 15%. Um, um, so this is a process. We are still the countries are still decided. The government are still decided. But the next step is as we have already um, mentioned. Um, the next step is the adjustment of the of the international double taxation agreement, the domestic legislations, and after that, all the private sector have to adjust to this methodology, which is really complex, because behind this there is a lot of technical issues as regards how to determine the income of obtaining in the related company, the deductions, how to calculate the effective tax rate. So there are beyond the political agreements, there are a lot of technical accountant and technical issues that has already been treated, but have to be explained to the private sectors. There is a long way ahead, but the political decision has already been taken.
As far as the terminology is used by you are concerned, like when you talk about parent company, when you talk about a related company, which you mentioned in your opening slides, like we can relate more to the terms like a holding company, as far as the Indian Companies Act of 2013 is concerned, and we also frequently use the term of a subsidiary company, whereby which is very similar to a related company which you laid down, whereby a related company may buy whereby they may carry out its operations at some other place, having a low tax in that kind of a jurisdiction. So that is the more usually used terminology as far as India is concerned: holding company and the subsidiary company, which is very synonymous, what you mentioned, to parent company and the related company in your introductory slides. So yeah, great.
Yeah, because the term that the OECD document uses is ultimate parent company, UPE. That is the name used by OECD documents, or constitution company. We can say subsidiaries. The we can say we can use another synonym, but the idea is that you have the head. I use the word headquarters, or but you can use the expression ultimate parent company is the expression that OECD uses. Uh, um, um, but the idea is that you have a company that concentrate all the decisions and owns all the others in the group, direct or by indirect way. And the idea is that there are other companies in the framework of the group that owns intangibles as a patent or softwares or any other intangible which are very easy to move to one jurisdiction to another, different from physical goods. So this is a very easy way to relocate uh, um, profits. You assign the ownership of any intangible to another company of the group in any non or low tax jurisdiction. I, I give I gave the example of patent, but could be the ownership of software or or another kind of intangible that serve royalties. So it's a way to shift earning to this uh, jurisdiction. So it's a very common aggressive tax planning that implies a huge amount of money and implied a huge tax evasion worldwide. That's the reason why G20 is so worried about this, and this is another measure among the others that have been already taken in order to counter this kind of aggressive tax planning.
So, do you see this becoming a reality by 2023? What's your estimate with respect to this?
Well, it's an ambitious deadline, um, because we don't know what the rest of the world is going to say about this proposal. As we have already said, we have 20 the 20 most important economy that have agreed, but there's still a lot of countries that have to discuss. Um, uh, you have to consider the private sectors and the political discussion inside each country. So I don't know if 2023 uh, it could be the year, but I think that uh, eventually are going to be adopted. I don't know when, but since the political decision is so strong, I think that eventually it's going to put into force, to enter into force this global tax. I don't know if 2023, because if you consider all the work that have to be done, is probably uh, a very short period of time ahead. But the decision is already taken. If it's not 2023, it could be 2025, but not more than that.
All right. So quite insightful, sir. So thank you so much for this session, for the taking out the time early morning, I believe, in Argentina. So thanks a lot for taking out the time and enlightening us on this kind of upcoming topic, new topic, I believe, which we will hear a lot in the future. So thank you so much, sir.
Oh, thank you, first. I really appreciate your invitation. I really appreciate you take me into account. And I also am very thankful to Paul University. And of course, I am available to help to assist you in whatever you consider I can assist you.
Thank you so much for the support and cooperation, sir. Thanks a lot.
No, thank you, thank you.
Okay.